Options can make you a lot of money or absolutely blow your account fast. So before you touch a single contract, here are the absolute basics that you need to know. And no, this isn't everything, but don't jump in until you at least know this. And quick heads up, as always, this is not financial advice. It's purely educational. Please do your own research and consult a professional as needed. First, what's an option? An option is a contract, not a stock. You're buying the right, but not the obligation to buy or sell a stock at a specific price before a specific date. Think of it like a reservation. You're locking in a price today for a move that you think is coming. And here's the key. One options contract equals 100 shares. So when you see a price of $2 on an option, that's actually $200 coming out of your pocket. So always multiply by 100. And for beginners, there's two types of options. First is calls. You buy a call when you think a stock is going up. I think Apple's going to run. I'm buying a call. And then there's puts. You buy a put when you think a stock is going down. I think that stock's going to tank. I'm buying a put. So put down is a way that you can remember it. So basically the foundation is calls equals bullish in most cases, puts equals bearish. And when you're buying options, which is what we're doing today versus selling, your maximum loss is only what you pay for the contract. That's it. You can't lose more than the premium that you paid. All right, now let's rapid fire the terms you'll see on every options chain. First up is premium. This is the price you pay for the options contract. If it shows $3, you're paying $300. This is your max loss as the buyer. Next, we have your strike price, and that's the price your contract is tied to. So if you buy a $150 call on Apple, that's the level your contract is going to be anchored to. And here's something that tripped me up as a beginner. You don't need Apple to hit $150 for you to make money. Most retail traders never exercise their contracts. They just sell it back when it's worth more than what they paid for it. So as the stock moves toward your strike, your option gains market value, and you can sell that contract at any point before it expires. So let's say a stock goes from $140 to $147. Your call could be up significantly. You could sell the contract, pocket the difference, and move on. No stock ever changes hands. But the key word is can. Selling early does not guarantee profit at all. If the stock barely moved, say it moved the wrong way, or Theta chewed it and your value's gone because you waited, for a while, you can absolutely sell it before expiration and still take a loss. Exiting early just means you're choosing when to close. It's not that you're automatically in the green. Now, if you do hold all the way to expiration, then the strike becomes everything. You need to be above it to have any value left. But as I said before, most traders are in and out well before that. The next term is break even, and you'll hear it a lot. Break even at expiration is your strike price plus the premium you paid. So a $150 call bought for $3 breaks even at $153 at expiration. But if you're selling the contract before expiration, the option market value is constantly changing and moving around. You don't need to hit that number to profit, but also you could take a loss well before you reach it. Both of those are possibilities. The next term is expiration date. Every option has a deadline, and that's the date the contract expires. After that date, it's gone. It's worthless. It's finito. Here are the main expiration types you'll run into. First is weekly. Those expire every Friday, and these are probably the most common for active traders. Then you also have monthlies, and those typically expire the third Friday of each month. Then there's dailies and 0 DTEs, which is 0 days to expiration. These expire the same day that you buy them. These are extremely popular. You hear about them all the time, especially on high volume tickers like SPY and QQQ, because those have options expiring every single trading day. High risk, fast moving, but we'll touch on this a little more when we get to Greeks. Quick note from future editor me, I forgot one thing, and that's because a lot of brokers auto exercise if your contract is in the money at expiration, and exercising is pretty much you're actually buying or selling those 100 shares that we talked about at the strike price. So if you don't plan to buy or sell, depending on what your option contract is, make sure you close out before expiration. Let's talk about leaps. long-term equity anticipation securities. And these are option contracts that expire a year out or more. More expensive, but it gives your trade like a longer runway. So more time equals more expensive, but also more room for the trade to work out. Less time is cheaper, but the clock can be brutal in some cases. Moving on, we have in the money or ITM. For a call, the stock price is above your strike price. Your option has real value. For a put, the stock price is below your strike price. Your option has real value in that case. And then OTM or out of the money, the stock hasn't reached your strike price yet. It has no intrinsic value, your options contract. And if it expires out of the money, you lose 100% of your premium. Gone. Poof. ATM is at the money, and that's when the strike price is right around where the stock is currently trading. It has the highest uncertainty because pretty much it could go either way. All right, let's move on to those Greeks that I talked about earlier. These are measurements of how your option is actually going to behave. And don't worry, you don't need to master all of them immediately, but you want to at least kind of know a little bit about them before you start trading. So let's jump into the first one, which would be delta. Delta tells you how much your options price moves for every $1 the stock price moves. So a delta of 0.50, if the stock goes up $1, your option goes up 0.50 or $50. So for calls, delta is going to run from 0 to 1. And then for puts, delta is going to run from 0 to -1. And here's a bonus about delta. Delta also roughly tells you the probability that the option expires in the money. So a 0.3 delta call has about a 30% chance of finishing in the money. And deep in the money equals a high delta. Deep out of the money equals a low delta. And then ATM or at the money is somewhere around 0.50. Now let's talk about theta. And this one can hurt you if you ignore it. Theta's time decay. So every single day, your options contract loses value, even if the stock doesn't move at all. Think about it like an ice cube melting. The moment you buy that options contract, the clock is ticking. And here's the sneaky part. Theta accelerates near expiration. That last week before it expires, that option can start bleeding really fast. That's why buying cheap short-dated options and just holding them is one of the fastest way to lose money in options. So don't do it. Next is Vega. Vega measures how sensitive your option is to changes in implied volatility or IV. When IV is high, options are a lot more expensive. And when IV drops, like say after an earnings announcement, options prices can absolutely collapse, even if you were right about the direction. They call this IV crush, and trust me, it's destroyed countless options buyers around earning time, which earnings are already a gamble. So before you jump into options around earnings time, just understand you're often paying a premium in the price for that volatility. And then once the earnings are done, that IV can tank, and so goes your options value with it. Next, we have gamma. Gamma is how fast delta changes as the stock moves. Higher gamma means your delta and your option price can shift very quickly. Gamma is highest for at the money options near expiration. That's why 0 DTEs, 0 days that we talked about earlier, trades can be explosive in either direction. You could have huge gains or huge losses in minutes. And you don't need to trade that deep in the Greeks right now, but you need to know they exist and know that at all times they're either working for you or they're working against you. Next, when you open your brokerage and pull up options on a stock, you'll find what's called the options chain, a list of every available contract for that ticker. Every platform is going to look a little different. Some show calls and puts side by side. Others, like Robinhood, separate them into tabs that you can toggle between. But don't get thrown off by the layout. Regardless of where things are, you're looking for the same information everywhere. The strike prices, the expiration dates, the premium, and then the columns for bid and ask, volume, open interest, and the Greeks we just talked about. And also, the bid-ask spread matters for sure. The bid is what buyers will pay. The ask is what sellers want. And the gap between those two, that's what they call the spread. A tighter spread is more liquid, and that's better for you. Wide spreads are thinly traded options, and they can quietly eat into your profit from the moment you jump into the trade. So always check the volume and the open interest, because these tell you how actively traded a contract is. I'd stick to options that are really liquid starting out. So let's run through something really quick. You buy one call option on XYZ stock. The strike, $100. The premium, $3. So you're paying $300. And let's say the expiration is 30 days out. How can it play out? Scenario A, the stock runs to $115. Your option right now might be worth $8 or $800 equivalent. You sell to close. That means you just made $500. For scenario B, say the stock stays flat or it drops. Your option is decaying every single day, and at expiration, it's worth, sadly, $0, and you would lose your $300. But that's your max loss, that premium that you paid. And then scenario C, say the stock goes to $103, barely above your strike. The option might only be worth $1 now, which is $100. You lost $200 out of your $300. You can still sell it before expiration to cut your losses though. But option contracts are only tradable during open market hours. So real fast, let me run through a bunch of mistakes that I see beginners making constantly. The first one would be buying short dated out of the money options just because they're cheap. Cheap equals low probability. The stock has to move a whole lot fast. It's possible, but Theta can eat you alive. Another one is buying options right before earnings without understanding IV crush. Even being right about the direction can still lose you money, and as you imagine, that can be super frustrating. So watch out for that. And then another one is holding a losing option all the way to expiration. Most experienced traders are going to cut their losses early. So when you can, or probably always, know your exit before you enter. And then another mistake is not understanding that one contract is the equivalent of like 100 shares. So that $1.50 option actually cost you $150. So the sizing of all of it matters. And then another one would be ignoring the bid-ask spread. Those wide spreads mean you're already behind from the moment that you enter. So in summary, I would say that's the foundation. Calls, puts, premium, strike, expiration, all the in the money, out the money, at the money things. And then the four Greeks that we talked about earlier, all that probably matters the most when you're getting started. You know, the delta, theta, Vega, and gamma. And of course, there's so much more that you need to learn as you get into it. Risk management, strategy selection, reading charts, position sizing. But if you don't at least know the things in this video that I talked about, I probably wouldn't start trading yet. I would spend some more time studying, paper trade if you have a broker that allows paper trading, and then step in, dip your toe, step in small. But that's it. Drop any questions in the comment, like, and subscribe if this helped, and I'll catch you on the next one.